Hello, thank you for taking time to watch this brief presentation about our UK multifamily strategy. When I joined Rasmala back in 2018, I was tasked to identify new investment strategies to generate secure income at a time when commercial property yields were compressing, and income could be generated only through the use of increasingly high level of leverage. My view at that time was that leveraging real estate to generate income was an unsustainable strategy and that an alternative approach was required. During the pandemic, I started discussing this idea with my colleague Dominique Chery, the CEO of Viridian Apartments, a serviced apartment operator owned by Rasmala. And gradually, the idea of investing in the nascent UK multifamily sector took shape. As you all know, multifamily is one of the largest real estate sector in the USA, representing almost 40% of the commercial real estate market. However, in the UK, residential properties for rent are primarily owned by individual investors, with institutional ownership of entire blocks, what we call the multifamily, at just over 3%. We believe this is about to change, and that over the next 10 to 15 years, the UK multifamily sector will grow to 30% of the UK property market, representing an incredible investment opportunity. Over the next few slides, I will give you more details about how we have decided to approach this sector and also explain why we find it so attractive. First of all, to clarify, multifamily is a term used in the USA to designate apartment blocks for rent owned under a single title deed by an institutional investor. Multifamily is distinct from single-family rental homes, which represent a separate asset class. In this presentation, I will use the term multifamily interchangeably with the term build to rent, which is increasingly becoming the norm in the UK. However, bear in mind that in the UK, people also use the term private rented sector, or PRS. For us, build to rent is PRS with some extras like furniture, bills included in the monthly rent, as well as some form of shared facilities. Private rented sector are simple apartments for rent, owned either by individuals or institutions. Also, for us, serviced apartments are very similar to BTR, but offer a much higher level of service, very much similar to a hotel. Now, as you can see on this slide, there are many ways to invest in places where people live, what we call the living sector, like co-living and student housing. We have decided to initially focus on the build-to-rent and serviced apartments sectors. And our thesis is that by combining the build-to-rent model with the serviced apartment model, we can generate an attractive income even without taking excessive amounts of leverage, and we can grow the value of our investment. This slide shows you the key drivers of return of our strategy. First of all, we have the rental income from the BTR properties we own, which we have seen is higher than normal buy-to-let. When we launched our first BTR property in the UK, we received a large number of inquiries and ended up filling all the flats in about 6 weeks, at a level which was 17.5% higher of that of comparable apartments in the surrounding area. Next, we had the profit of operating our serviced apartments, most of which are leased rather than owned. When you look into the business model of a serviced apartment company, you will notice that it benefits from operational leverage. With overheads fixed, the more serviced apartments we add to the portfolio, the higher the income we are able to generate. Beyond income, We also aim to grow the value of our investment through passive exposure to an asset class which has a proven appreciation potential, as well as through active development strategies. The other two drivers of performance are tax savings and liquidity premium. Tax savings are expected when we convert the fund into a REIT. Without entering into many details, I will just mention that over the last few years, the UK tax code changed in a way which really discourages direct investments in residential properties by individual investors. It is clear that the government wants to encourage institutional ownership of real estate, and REITs are, in our opinion, the ideal vehicle to achieve that. And finally, we believe that after listing, the shares may trade at a premium to NAV, because our REIT will also own the operator, something which should boost the income potential of the underlying property portfolio, and therefore justify a premium. Let me expand a bit more on the income and capital appreciation drivers. In this slide, I show the way we plan to blend BTR and service apartments in our portfolio. At present, we have around 500 serviced apartments and 60 BTR apartments. Long term, we plan to reverse that and to have the majority of the portfolio in BTR, because this type of property generates a more secure and less volatile income, with serviced apartments representing around 20% of our portfolio. Now, in the UK at the moment, most serviced apartment blocks are physically distinct from BTR blocks. However, we plan to merge the two strategies. So when we acquired our first BTR block, we decided to blend BTR and serviced apartments to better manage our occupancy and optimize the yield. Also, adding serviced apartments to an existing BTR block is a less risky way to test the appetite of serviced apartments in new markets, because if the offering doesn't work, we can always put those serviced apartments on the normal rental market. Now, these slides encapsulate our thesis of why the UK residential market is one of the most reliable asset classes. What you see here is the price of an average house going back to 1968. As you can see, in 1968 it costed about £2,600 to buy a house, which today would cost you around £260,000. Even if you bought a property just before the real estate crisis in 2007, today you would be well in the money. Now, the question, of course, is, will it last? Our answer is most probably yes. Starting from this slide, I will explain why I believe the income and capital value of this asset class is so reliable. First of all, as you can see, younger generations are less likely to own a property than older generations. 60% of the so-called baby boomers, those born between 1945 and 1965, owned their home by their 30s. Conversely, only 40% of millennials, those born between 1981 and 2000, own a home. The rest are renting, either because of lifestyle considerations, they want flexibility in life, or more often because they just can't afford to buy. In this slide, I show why houses are becoming more and more unaffordable in the UK. The vertical bars show you the average size of the mortgage required to acquire a home. And the line shows you the ratio between house prices and per capita income. As you can see, When house prices grow faster than average income, that multiple increases, requiring households to take ever larger mortgages. At some point, however, households run out of borrowing capacity and need to resort to the rental market. In this slide, we see another interesting development. As inflation spiked following the pandemic, the Bank of England had to increase base rates, which led to an increase of mortgage costs. This slide shows that at some point in August of last year, it became cheaper to rent rather than buying a home. Now, how has the rental market responded? As I mentioned before, rental apartments in the UK have traditionally been owned by individual investors, which have been attracted by the security of income and potential capital growth. In particular, UK banks have devised a buy-to-let mortgage product, which allowed individual investors to leverage their investment in rental properties and acquired more than one property for letting. However, over the last few years, the tax code has been changed several times, with the latest change depriving individual investors from the benefit of deducting interest expenses from their taxable income. Furthermore, the government has introduced a regulation requiring landlords to improve the energy efficiency of their properties by replacing gas boilers and improving insulation. These changes have led many individual landlords to withdraw their property from the rental market and sell them to end users, something which has led to a huge shortage of rental housing. What this chart shows is the response of institutional investors who have been pouring increasing amounts of capital to fill the gap left by individual investors. But it is a drop in the ocean. At the end of 2022, there were only 70,000 institutionally owned for-rent apartments. This next slide shows the amount of capital which is going into the sector. Knight Frank estimates that by 2028, the BTR sector would have reached over 100 billion. If we extrapolate the example of the USA, that number could reach 500 billion pounds in 10 to 15 years. But at present, the amount invested in the BTR sector is small. Look at this chart prepared by Knight Frank, which shows you the percentage of the BTR relative to the private rental sector in various cities. Only Manchester has crossed the 20%. Every other place is low single digit. Now, in the next few slides, I would like to share with you why we believe now is the right time to invest in the sector. As you can see, the whole curve of interest rates has come down since September, reducing the pressure on real estate. There are some views in the market that rates could come down further, especially if we have a deeper recession forcing the central bank to start quantitative easing. Anyway, at this level, leverage is not really accretive to real estate investments. Next, I'm showing the inflation swap curve, which I use to gauge inflation expectations over the long term. As you can see, these have also come down visibly since September, but we are still looking at a rather elevated level of inflation. For real estate investors, inflation is a positive element because it causes rent to grow. In this slide, we can see very clearly the gap between the rental yields of the BTR sector and 10 years yields. If you assume that borrowing cost will be at a spread over risk-free rate, you can see very clearly that the gap has disappeared. But also, you can notice that rental yields of the BTR sector have barely moved, which means that the capital values have not declined substantially, since over the last 2 years, even though interest rates rose sharply, there was a phenomenal growth of residential rents, which has compensated the increase in the cost of capital. In this slide, which is taken by the CBRE UK Property Market Outlook, you can see two things. First, that property yields across all asset classes have probably stabilized at the beginning of 2023 and are not expected to rise much more from here. Now, this is a good news because the much feared 30 to 40% correction of the property market values is probably not going to materialize, especially in the residential sector. But you can also see that residential property yields are expected to be lower than the other sectors. Now, this might sound contradictory to what I said at the beginning of the presentation when I mentioned that I was looking for a new strategy to deliver attractive risk-adjusted returns. However, don't forget that in the new world of higher cost of capital, it is not the rental yield that counts, but the growth of the rental income. Now, to conclude, this is more evident in this last slide. The total return potential of the residential sector is more evident in this last slide, which shows the total return expected over the next 5 years. As you can see, the residential sector is expected to outperform offices and retail and generate a total return similar to the industrial sector, which benefits from an equally strong occupier demand. So, in conclusion, in a world in which we cannot implement any more profitable carry trades with cheap debt, we need to switch our focus from investing in fixed income to investing in growing income, which will be the strategy that will deliver a superior risk-adjusted return and protect our capital from the erosion of inflation. Thank you very much for listening, and feel free to reach out if you want to discuss further.